want to thank everyone for joining us today, and as we give this market update. And one of the things we felt was really important was to kind of, as we started this new year, there's the traditional market outlooks that we go through at the beginning of every year. And this year has kind of felt a little chaotic as people have watched the news and seen everything that's been going on. There's a lot to filter through and digest. And so we thought, rather than do another market outlook for everyone, we thought maybe, hey, this is a better time to give a market update and just talk about what's going on kind of in the world a little bit, but really what should we be thinking about in the markets and what is really important from everything we're hearing out there today. And to do that, we're joined today by Ben Keating from Thornburg Investment Management. Thornburg is a company we do a lot of business with, a asset manager. They were founded in the 80s. And one of our favorite things is that they're based here in Santa Fe. So whenever we need access to Thornburg, their team or their resources, we can give them a call, and sometimes they even invite us up the hill there to their fabulous property. So Ben joins us today to give a little presentation, and then we'll open it up for Q&A. But we want this to be as conversational as possible. And so if you have any questions while the meeting's going on, please go ahead and you can put those into the chat. You can also call the office and talk to anyone on the team and give them your questions, or email any of the team members here. But with that, we'll go ahead and pass it over to Ben to give himself a proper introduction. But again, Ben Keating from Thornburg Investment Management. Thanks, Ben.
Yeah, no, great. Thank you, Kyle. Thank you, Contessa, for setting this up as well. Thanks to my colleague, Matthias, for helping me get on. Yeah, I enjoy this. I'll certainly give you my comments, our thoughts. There is a lot going on. I kind of joke, there's nothing going on. There's everything going on, right? And normally you tend not to get too hung up on policy or politics, but you can't deny it's a pretty important issue at the start of this year. And just to kind of give you my background, so I'm more of a generalist now. I've been doing this over 30 years. Used to manage fixed income extensively. I think the fixed income lens is very important, so I certainly will bring up that. The Fed is still very germane to this conversation. It's not all politics. Where's inflation going? Where are jobs going in the U.S.? It's a big part of the economy. But in my role as a generalist, I'm actually based in Boston, but travel the whole country representing all of our teams. Roughly about $50 billion that we run for Thornburg across different mandates. But it's been a really good run. A lot of discussions, a lot of insights and discussions. My role, I view it two ways. It's just kind of, I'm certainly sharing the views of our multiple teams, but it's also a good chance for me to interact with folks like yourself to hear what's up in certain parts of the world. So I really enjoy this. Hopefully it's going to be a good interaction between the two of us, and your clients will be able to ask some questions as well.
Great. Thank you. Yeah. Well, with that, maybe we just go ahead and dive into what are some of the big things you're seeing in the market right now, Ben?
Yeah, I mean, as I said, so maybe I'll start back. I think everyone's minute by minute. They're just thinking, I know there's a press conference between Trump and Erkan today. You're seeing a lot of interesting discussions. It seems like there's everything minute by minute. It's hard to remember what happened the prior week, right? So take a step back, pick it up from last fall, right? So clearly, and this is not to deny there's incredible, social and cultural changes that have gone on the last several years, certainly pandemics. First time we've had one of those in a long, long time. So you're still reeling from some of that, but without a doubt, you can't deny objectively that a lot of people across the globe are looking to kind of turn the page since November, in the sense that maybe this is a chance to get some efficiencies, to get some certainties, to get some of the global geopolitical risk in that was really uncertain 2 or 3 years ago, to maybe get some better certainty. Now, I don't want to be Pollyannish. There's a lot of issues that cannot play out. And that's the thing. I think understanding that no one has a crystal ball, that it's going to be constant. You're going to see a lot of perhaps changes to some of the assumptions that I'm making today. But the good news, I think, because it's been 10 years really since we've had Trump in particular, you can't deny Trump is a major figure in all of these conversations. And this is not meant to be left or right. It's just, it is what it is, right? You can't deny that this is the major conversation that all investors are looking at. But I think with 10 years, you're kind of somewhat used to the tone, you're used to the kind of the style. Remember, I know we're going to talk a lot about tariffs. That's a big part of what we're looking here. And frankly, that's really it's very hard for investors because really from day one, when the election was finalized last November, they've been talking about hitting the ground running. And sure enough, when they inauguration, it's been a very strong start for them trying to get changes done the first 100 days. And as it relates to that, I think the markets are pretty used to the style. Normally, any one of these issues, whether you just have a trade war, which really wasn't expected, for example, between Mexico and Canada, right? The major target was China, maybe the EU to try to get some negotiations towards the Ukrainian war. But all of a sudden, out of left field, we got a trade war and tariffs that are still likely to take place at the start of next month in Mexico and Canada. A lot of people didn't even see that as a major issue, right? They thought that there was decent trade amongst those. So it just shows you how left field some of these policies can start, at least in conversation. But again, remember, there's a little bit of the art of the deal, right? That there's this kind of the opening salvo of this is the opening stance to get something done. And it's not meant that all these tariffs, if they are in place, so to be sure, if all these tariffs take hold and stay in the system for this year, that's not priced in. That would be detrimental to a lot of investing. So it's something you want to watch. But the base case is most people watching this, for example, on the tariffs, that is the major story outside of rates, that they'll get some agreements set in place, and then you'll kind of turn the page and move on, and maybe perhaps get some things done. So just going around the world, for example, as it relates to tariffs, and I'll come back to the inflation and Fed funds. So look at the U.S. So Mexico and Canada, there's now going to be tariffs. No doubt, if that were to go on, Mexico and Canada would lose that battle. They stand a lot more to lose than we do in a prolonged battle. But we think at Thornburg that the reason why Trump is doing this is twofold. It's really meant for immigration policy, which is a major campaign of his. He wants to strengthen the border. He wants cooperation from Canada and Mexico to help close the borders to illegal migration. And as it relates to Mexico in particular, he wants additional teeth to fight Mexican cartels, to fight the drug war. That fentanyl in particular has been a scourge in the U.S. That 100,000 people killed every year. So that's been a campaign of his. So we do think the tariffs, as it relates to North America, Mexico, and Canada, those are the two main issues. So it shouldn't be necessarily as prolonged a trade war or tariff war if you get some concessions on those. And there's early signs that may very well happen, despite the rhetoric on both sides or between the other countries. Turn the tariffs towards the EU now. Again, it's not a strong trading power. There's not a lot of trade per se outside of Germany manufacturing between the U.S. and U.S. and Europe, other than tourism. But it's still a war, still a major, $3 trillion trade arrangement, one of the biggest partners that we have in the world. So any tariffs would be what Trump calls reciprocal, but not really. It's a new tax. And it would certainly cause uncertainty in the economy and probably be more inflationary. All these things, if they take hold, are inflationary net cost, right? So this is why you want to watch it close. But we think Trump administration is trying to put pressure by adding tariffs to Europe to help end the Ukrainian-Russian war, which is already taking on a different task. Trump very aggressively wants to end the fighting right away, and then hopefully get negotiations on territory and mineral rights afterwards. So again, it's a messy situation. We hope it ends. Certainly humanitarian nightmare for 3 year. 3-year anniversary just happened today on that war. But it's also, again, I'd remind people, remember how bad things were in 2022 when you still had COVID raging, Chinese shutdowns, and then you had the war break out in Ukraine. So you were certainly a little bit more disruptive or uncertain 3 years ago than you are perhaps today. So for anyone on the call that's really unnerved by the mechanics of the trade war, the tariff war, I just remind you how bad things were 3 years ago and how kind of your worst fears tend not to play out as it relates to economic toll. So keep that in mind. But we'll watch it. It can play out in various ways. And then lastly would be China, right? So China is a major story that doesn't get enough attention. They tend to play the long game in China versus kind of Russia. It was more old Cold War, obvious Cold War mentality. But China, unfortunately, for those who want to kind of remove themselves from China trade, it's kind of too late for that. You've had almost 30 years of joined at the hip trade. We really big manufacturing partner that you can't say no to today, right? So that's both sides agree that, Republican or Democrat. You can try to move away from that, which is what's been tried maybe even before Trump. You try to get the deglobalization, you try to get trading arrangements with other Asian partners in Vietnam and other parts, but it really has not played out as well. China is still a major trading partner. So that's the big story that I think that most people want to focus on. It hopefully will ease the fears of a Taiwan. There's always this fear that China will take over Taiwan and start a very serious war. So you want to make sure you watch that. But again, versus 3 years ago, I'd say the odds have come down. There's a lot of internal strife in China that's causing their leadership to be more guarded about political aspirations or military aspirations. So we'll watch that one. That's ironically has not flared up as dramatically as Europe and Canada and Mexico as far as tariffs. But those are major stories that you're watching. Again, all three of those by themselves would be major events, say 10 years ago. But because we're kind of used to this rhetoric from Trump, the markets are taking, I think, relatively in good stride, and they're cautiously waiting it out to see how this plays out. But as I mentioned, it's not priced in that this will be a severe, prolonged tariff war. That would be detrimental to investing. You'd cause a lot more volatility. But you're going to wait and see if you can get some negotiations and agreements done the next 6 months. So let me stop there. I know I threw a lot at you. I know, Kyle, you wanted to talk about tariffs. I'll certainly turn the page
No,
towards inflation next.
yeah, I was just gonna ask a question on tariffs. Is it really just regional in terms of what gets hit with the tariffs, right? Steel in Canada, maybe semiconductors coming out of Taiwan and China. Is that what we're looking at, or is it kind of like, is there an area we should really be watching as an investor to say, hey, this tariff is really going to create a bigger impact than something else?
Yeah, it is. It is so hard. I mean, and I think it was probably harder maybe 4 months ago, right after the election was finalized, in that he just was throwing everything against the wall. That just everything was going to be a tariff. Everything was. But I think if you look behind, I think what's probably going to take hold is clearly the steel tariffs. And I didn't mention Japan, so Japan and China are clearly benefiting from unfair steel practices for generation. I think Trump is really adamant about that. That's an easy give to. He's a believer in that, to give to the steel unions, of which they're really benefiting from that. So I think that's one tariff that'll probably take hold, and it's actually been in place. Even Biden let that come through in his administration. That was left over from Trump original administration. But yeah, I think it's just that's the craziness of, or I guess the cleverness of Trump, right? He can say a lot from a very big megaphone and say broad strokes, but he does prove himself out if you get enough negotiation, at least some good faith that he'll maybe pull back and pause the tariffs and maybe not be so punitive on certain industries if they're showing a willingness to change. So for example, Apple today just announced that they're going to probably spend almost, hire 20,000 people and spend several multiple billions to build data centers here in the U.S. So why would Apple do that? Because they know they can get cheaper data centers elsewhere. It's because they're trying to stave off anything directed towards that industry. And there's a good reason why you saw most of the tech leaders at the inauguration, right? They know that there's some real money being spent. There's a huge tech arms race that's taking place with AI. It's a race to see who can win out in various sectors related to that. And as it relates, you don't want to have the Washington administration either through tariffs or regulation really sour that growth of that innovation, right? So, and I think that there is some truth that there's animal spirits. You hear that term a lot. No doubt, you have leaders that were maybe on the sidelines politically or coming out in favor of getting at least cozy with the current administration because they want to have unfettered access to money to lower taxes, lower regulation, and no tariffs as it relates to the growth. So that would be a key one, Kyle, to see if you see anything related to tech and chip making. I think that's just such a big pie that I don't think even Trump wants to confuse that by heavy tariffs in that industry, despite rhetoric about some of the nations that are being tariffed. And again, as I mentioned, so just as it relates, going back to hear this a lot, Mexico, Canada, EU. I don't want to say they're irrelevant trading partners. They are. It's a lot of money flowing between those countries. But as far as who stands to lose in those three areas, Europe, Canada, and Mexico, it's clear that we have the upper hand in the U.S. And they may talk tough politically, and but they're gonna probably buckle on some of those. And I think, Trump realizes he doesn't really intend to have a long, high tariff in place for a long time. It's really his opening agreement tactic to get some concessions on key issues. And as I mentioned in the case of North America, it's not even economic. It's immigration and illegal drug cartels are the main ingredient to try to go after tariffs in those two theaters.
That's great. Thank you. Yeah, maybe we'll shift. You want to talk a little bit about inflation, the risks? I mean, I think there's a lot happening that could create inflation, tariffs being one of them, but maybe we look at, immigration policy, the U.S. workforce, but what are some of the drivers that you think maybe could bring inflation back, or what risk does that create to kind of how we invest?
Yeah, I mean, maybe just briefly taking a step back. I mean, someone who managed fixed income for a long time. I mean, I know people were hoping the Fed would pause, which they did, and then, or cut rates, and then eventually, just collapse, go back to zero interest rates, because that, boy, wasn't that fun to have zero financing on your mortgage and your car and stereos. But I think reminder that was maybe good for people that were able to take advantage of low rates, but it's certainly not a good long-term plan to have negative yields or zero rates or deflation or threat of deflation, right? So that's hope that we don't go back to that. And there's probably signs that we're not likely to go back anytime soon. I'd remind people that's not a bad thing. So it's too bad that I think people thought maybe the Fed would just keep cutting all this year into net. And again, they may have sent some confused signals as to what they were going to do. But for those who don't follow closely, the Fed did pause this last meeting and are likely to stay paused for some time. Why is that? It's probably for good reasons, because the economy did not fall into recession like they thought. And employment's been very, very strong. It's been much stronger than most people think, even perhaps a lot of us at Thornburg, right? So take heed that that's actually not a bad thing. It's just frustrating because you're thinking, is this where we're at? We're going to have to live with higher rates. And a lot of people equate that with kitchen table items like their inflation. You're certainly seeing a lot of items that are much more expensive today because of inflation than they were 5 years ago. There's a big reason for that, but it's just in general, too much money chasing too few goods, too much spending. And if you look behind even though we're paused at the Fed, there's signs that the economy is still likely to slow, that the consumer's tapped. You just saw today from the Wall Street Journal that, that sadly you're still seeing good spending, but it's really concentrated in the top 10% of earners that are spending almost 50% of the consumption. And that's certainly a demographic nightmare. I think everyone knows someone is really struggling with job security or just paycheck to paycheck based on higher insurance, on higher mortgage, on higher rent. It's all factored in. So I'm not denying that there's, again, profound social and cultural changes going on. But economically, you can't deny that you're not likely to see a recession in total. This is a very complex and amazing economy. I keep saying, Kyle's heard me say this before, I know Matthias has, it's an amazing time to be alive as an investor. So we'll talk about a lot of topics here, but don't deny Thornburg investors as a whole are very pro-cyclical, pro-risk, very optimistic about the opportunity set. They're just like Kyle's asking, they're just trying to knock down some of the uncertain aspects of investing one by one. And obviously the big story outside of tariffs is, where is the Fed going to go? Because it drives so much of the economy, drives so much of lending. So as it relates to lending is still pretty robust, right? It's sad. There's more debt than ever. A lot of that's been issued by governments, right? Sovereign debt. The U.S. government's at 38 trillion, but a lot of other governments had to issue debt to help COVID mitigation the last few years. But despite that, I think there's $350 trillion in debt now, stunning number. Despite that, corporations, munis, individuals, mortgages, they're in pretty good shape. So you're always looking in the fixed income, the health of the markets. It's much healthier today from a credit standpoint, downgrade risk, liquidity. You don't hear any whispers that we saw, like, God forbid, '08, like a banking crisis, systemic risk. That's not whispered. And for good reason. We're still, the benefit of post '08 is most companies, most individuals, their balance sheets are better today than they were at any point, in some cases in their lifetimes, right? So that's helpful to be less fearful. And it's a big reason why the Fed is not cutting rates. It's because you don't frankly need to right now. You want to just make sure you've stamped out inflation. You can have another whiff of inflation if people get irrational exuberance and spend a lot again, but that's not likely in our case. I don't think rates will go higher from here. they'll probably generally just keep coming down over time.
Oh,
And but again,
I was going to ask about the rates increasing just because for the first time, we watched the Fed watch on CME quite a bit, right? And so for the first time in a long time, they added in the column for a potential chance of rates rising in early
yep.
26. I guess May 26, I think is the first time it appears. And so I was wondering what you thought. I mean, while they put the probabilities pretty low, it's, we see it out there kind of as, I mean, it's a benefit for some people, right? Fixed income investors, but also probably a risk to the markets if we saw that where they're saying, hey, why are rates going back up again?
Right. Right. Well, I mean, and again, always ask yourself what's priced in, what is the market thinking and what's likely to happen. That's not priced in at all, even though they've added a column. That would be very detrimental to anything. Treasuries, obviously, yields go up, price goes down. So the Fed all of a sudden turning on a dime, saying they're going to raise rates, that would cause some troubles all across, and at least in the short term. Again, why we think that's unlikely is because the Fed. Remember, the Fed funds deals with the very short end, the overnight part of the curve. They don't have as much control because it's such a massive market on the rest of the curve, the rest of the yield curve. Sorry if I'm using terms that are kind of inside baseball, but it's just think of it. I mean, a lot of people have been on the call, have been around a long time. Remember that a lot of people think, what's the parallel? What does this feel like? A lot of people thought maybe this felt like the 70s and the 80s when inflation was running rampant. That turned out not to be the case, but it feels to me an awful lot like the 1990s. If you recall, that the start of the 1990s was very uncertain. Fall of the Cold War, the collapse, spent a lot of money on Cold War, fall of the Soviet Union, a terrific amount of lending problems and uncertainty in the world. But if you look in total, the 1990s was an amazing time to be an investor. Great innovation, great productivity, great globalization. But I just say that I remind people what the average inflation in the U.S. was for that decade. It was 4%. So just if we somehow pause at kind of 3 to 4% inflation, and the Fed funds is kind of 3.5 to 4.5% in the next few years, yeah, you don't get that huge collapse. You don't get a pop. We don't get zero financing on our cars. But it's maybe not a bad thing for investing. It tends to, think about lending. You probably should charge extra yield as a lender to people taking a longer risk. A 10-year, 30-year should really have a higher yield. It used to be the yield curve was upward sloping. You used to have get about 5 or 10 basis points more per maturity. And if we go back to that, I'm not saying we're predicting that either. It's too hard to predict anything right now. But if we somehow get higher yields on the long end and the short end goes a little lower, that's maybe not a bad thing for borrowing. It tends to stop a lot of egregious lending and lower default rates, all of which you want to watch too. Again, it's a complicated picture. You get a lot of moving parts to fixed income, but just think, we want to buy low and sell high like anyone else. We don't want problems. We want our lenders to pay us back. They want us to pay interest along the way. So these are all things you want to check the box. And from that standpoint, Kyle, I mean, it looks, despite all the rhetoric, it's a very healthy market, which is a bit of a paradox by having so much debt outstanding. But right now, no one's worried about default risk or liquidity risk or any major banking collapse because there's pretty good balance sheets across the board left over from '08.
That's great. Thank you. That's helpful. So maybe if we're thinking about the 90s and going through the 90s, obviously, the emerging of the internet really, and but it all ended in these high valuations, right? And so people are looking at, I guess, with the tech bubble bursting at the end with those valuations. And I know the kind of the revenue perspective of the companies is different now, but people are looking at the S&P 500 and both their high valuations and combined with concentration risk. Is there, something we should be looking at there where we're trying to manage that risk or avoid it because people are really nervous around high valuations right now?
Yeah, it's tough. I mean, that's the real pause. I mentioned we've got great optimism and great time to be alive as an investor, but the challenge is from an historical standpoint, you're at really tough levels of valuation in the U.S., especially high beta growth tech has been seemingly the beneficiary. If you strip that out, it's been maybe more of a mediocre rally. And then you turn to the fixed income side again, the corporate bond spreads, which is kind of a technical term. a lot of people watch that. You're back to all-time tights on high yield spreads. So basically, companies can issue debt at some of the best levels from a spread standpoint that they have in their history. And normally, that's when the cycle starts to break. You start to see signs that, you know what, maybe we're priced to perfection. Maybe we should start to push back on some of these sectors. And again, there's a natural cycle to everything. There will be a recession at some point. It just doesn't look as likely for us at Thornburg to happen this year or even the next 18 months. But remember, we didn't talk too much about the other global data economically, but the other parts of the world are in tatters, right? Europe is really messy. It wasn't just the war, but just really tough manufacturing base, and they've really decimated a lot of their trade from a strength. So there's fraction there from a economic standpoint. China has been just in a horrible mess. Numbers that are really recessionary from their standpoint, even though they hide a lot of the data. But terrific, and they're cutting rates. And there's more deflation fears in those theaters. Like, so
I
as
was
much
going to
as
ask
we're
there,
very,
right? If we looked at both Europe and China leaders for the stock market to start the year, but sort of we're hearing the inverse on their actual economic position, right? Is that the
right.
stock market is the leader, but their economies actually maybe aren't as strong as what we're seeing in the markets.
Yeah, which would lead you to say, all right, great, I'm glad. I mean, so somebody on the call, I'm glad I'm not investing in those theaters, right? But I mean, here's the thing. You start to invest before the economic turn happens, right? If it's already priced in, maybe you start to look at those theaters. I'm not saying China's still a little bit too toxic for most investors, but a lot of us at Thornburg think the better relative value, perhaps it's overpriced in all the negative news. Perhaps there's some resolution in Ukraine war. Perhaps China doesn't invade Taiwan. Perhaps North Korea behaves. Iran is already in kind of a box. If all that happens, and all of a sudden you see where's the better relative value, you may very well see some flows which have really neglected. In all my travels, I think that's probably the most neglected allocation is to international equities. That might get some more love, right? And it's all about, again, why would I go there now if it's a messy situation politically and economically? Is it already priced in? And will the consensus improve the next year? If it does, if you're an early investor, history shows you tend to get a better beneficiary returns in that scenario. Again, you don't need to move all that in one trade, but it's something you should think about. You and I haven't talked about it specifically, but just thinking about when you got a cloudy crystal ball, just look at all your allocations across your portfolio and just try to see if you can spot any biases. Everyone has a bias. A lot of people snuck in a lower duration on fixed income when rates were zero. And a lot of people understandably have shunned international investing because it hasn't really given you anything of healthy returns, right? It's US has been everything. And it's hard to say because you can't deny the US is by far the strongest theater. And it looks to be, and again, animal spirits are running fairly strong in the US and maybe not so elsewhere, but it may be a good chance to look at other options. But just coming back to the idea that there's one other policy that's taking place that's somewhat maybe deflationary or recessionary is that the DOGE, right? So the regulation that's going through to kind of judge efficiency, and that's getting just as much attention perhaps as Trump with Elon Musk. But it's real. When you already say maybe the cut line today is that the defense spending, which is one of the biggest spending, almost $1 trillion annually, may cut 8% in the next 4 years. That's a big headline. That's not something you expect from a Republican administration. No doubt you're going to get some Senate and House people push back on that, so you may never get that. But that looks likely that you'll get a reduction in headcount and spending. So you may very well get a localized recession in Washington, which some people may wish for, but it could have an impact and be somewhat recessionary or at least disinflationary to the U.S. and maybe cause some signs that the Fed may cut rates based on that. So watch that. That's a breaking story. Everyone's talking about tariffs and inflation, but you can see by efficiency, if you start to cut federal spending, massive amount, you're talking a very big annual budget that could be cut even by 10%. That's maybe something that'll show up in some deflationary issues and lower rates overall. But it's, again, too early to see. The devil's in the details, but it's definitely something that not many people were talking about it certainly a year ago as being a phenomenon that would happen in Washington.
So we're seeing, I mean, obviously with inflation occurring, I mean, higher prices, but we're also, so in that we're seeing higher revenues to corporations, right? We're seeing, I mean, I think the US was slated for, projected 13%, growth of corporate revenues this year. And in line with that, we're also seeing some growth of like earnings per share growth as well. I'm just curious, is there a place where you start to see cracks in that where like we as investors are going to say, okay, they can no longer pass through inflation to the consumers, or where the consumers are too impacted where they stop spending? Is there a place? It's like the Wall Street Journal article, I read that this morning, right? Saying, hey, all the spending's coming from the top
Yep.
10%, right?
Yep. Yeah. I
And
mean,
maybe those are the cracks that are already showing there.
I think you're right. I mean, and I hate to say it, it's getting attention now, but it's really been ongoing for generations. It's a very much societal event that, why is it so much wealth continues to get accumulated at the very top? But I guess you just look at the productivity, especially now when you see a complete overlay of AI tech spending. That's really where, you talk about the wealth effect. It's heavily concentrated in the last 2 years in AI related jobs and AI related companies, right? And infrastructure companies. But I think and that gets all the attention. But you are to your point. Starbucks just announced 1,000 corporate jobs today, so they're feeling, even bougie coffee shops like Starbucks are having to pull back because I think they know, even that clientele, there's a limited amount of discretionary spending. They just spent so much more on insurance, on rent. Their job security is maybe okay, but it's certainly not enough to spend more. And all the while, you've seen a lot of the entitlements and the extra COVID payments are long gone. So that's why you've seen that tail off for 90% of the consumers have really tailed off their spending since the peak of COVID. And that's been great for inflation success, right? Inflation's dropped, but it just leads you to say some of these really tight businesses that are driven by a general consumer. Walmart's given some tough earnings guidelines. They're seeing softness in their signs. Again, none of this would speak to a recession, but it's to your point, it's signaling at least you're going to see maybe some choppiness on their earnings guidance and maybe some misses on their actual earnings results this year for the first time in several quarters, right? And that tends to spill over to others. Other will kind of use it as an excuse to say, well, if Walmart's having trouble, well, then I better give some negative guidance. And I hate to say that that's maybe a good thing, that you kind of just tamp down expectations on earnings growth or earnings multiples. And then you may see a correction in the equity market in the US if that were to occur. But our base case is that if we do see a correction, anytime you're at or near all-time highs, it just increases your odds of a formal correction, which for those that not familiar, it's 10% pullback is a formal correction on equity markets. But I'd say if that were to occur, most investors, including Thornburg, would probably stand to come in if there was unfair selling in names that are offered good value down the road. Because turning the whole lens 3 years, 5 years, 10 years out, these companies that are in most of the S&P 500, not just tech companies, are incredibly profitable, incredibly well run, have amazing balance sheets, can kind of thrive in really any setting outside of a major recession or major prolonged tariff war. And if it's just a general, what you see is what you get, most of the S&P 500 companies are going to be just fine. And they may miss a couple earnings here and there. They may not have, I think it's safe to say we're not going to get 10%, 12% monthly returns the way we have in some cases, right? You're going to have to calm down the expectations that we're going to have just all up. If you go back to kind of mid-single digits, high single digits performance in most bellwether, dividend paying names, that's not a bad environment, especially when rates have kind of moved back down lower across the globe than where they were 2 years ago, right? So relative value is again, it's a relative term, but I would say no one has a crystal ball. You want to stay disciplined and really look for genuine fears. I mean, not to say that we're just as paranoid as anyone looking for real events, and we just we don't see a very cloudy picture for the U.S. economy. It's good employment. Fed is maybe not cutting as aggressively, but they're not likely to hike. And if we can kind of manage the current situation, kind of what you see is what you get. You deal with rhetoric from Washington. You deal with tariff wars that don't pan out. Most companies are going to be just killing it. It's a really good backdrop for productivity and profitability. Again, look at it from a global lens. A lot of US companies are positioned to benefit from growth in other theaters across the globe. It's a much bigger global economy than ever that gets under attention. But most companies are really well run. And then, oh, by the way, there's this thing called AI that's terrifying on some cases from a society standpoint for some people. But it's without a doubt, it's a productive tool in the early days and can lead to productivity gains. And that's really what the Fed, it's a magic word for the Fed. They love productivity. And it's a magic word for investors. They love when workers can be more productive than otherwise the case. And that's, I think, is being undercut. I think there's still going to be some productivity gains outside of tech that have yet to come through in other areas of the economy.
Okay. I just want to remind everyone that I'm always happy to continue asking questions, but if you have any questions on your mind, please feel free to put them in the Q&A and we'll do our best to answer them. So if we're looking at the headlines, right? Many of us, whether we're on the Wall Street Journal or the New York Times, we're logging in each morning, we're taking in our news. Are there places where are we digesting headlines and what really is a risk, right? Because everything's being thrown at us right now, particularly out of Washington, but there's a lot of other news, around the world. Is there a place where we should just be watching like, hey, this is something I should really be nervous about? Or is that just, we don't know what that's going to be yet?
Yeah, that's a great question. I mean, it's sad. I mean, if you really listen to the news, right? So I've got 4 kids and I try to figure out what they're listening to, what they're following. And again, part of my job is just to kind of keep an ear to the ground. What's changing from an economic and societal standpoint? It is I love my job. You realize how great this country is, how complex this country is. But yeah, it's interesting. In a lot of the news, just you'd want to curl up in a fetal position on your desk, right? It's so negative. I'd say just take a step back. I mean, there's not a coincidence that when I travel, I see amazing people that are very productive. I ask the same questions. It's a great question, Kyle. Like, what's perhaps my bubble? Because again, everyone's got a bias. Is there some other way to look at it? I still, almost 30 years plus doing this, read the Wall Street Journal religiously. I think they're fair-minded. They're certainly biased towards pro-tax or pro-low tax, less regulation, but they tend to cover the right subjects related to investing. So get in the habit of reading that. But yeah, some of the stuff that we're looking at internally, Thornburg's got a great culture of we call it a family dinner. We're all generalists and we share ideas of what's going on, and we cover a lot of ground. But a lot of it is along the lines you've asked, right? It's tariff related. You want to see how crazy that could perhaps get. Is it really getting better on geopolitical risk? It seems to be a better theater today than it was 3 years ago in China, North Korea, Taiwan, Iran, Ukraine. But is it, right? So you just want to keep gut check that. And then lastly would be, related to rates, try to figure out what the Fed is talking. It's always good to follow reserve members because they tend to do trial balloons. They tend to see, because it's not a science, it's an art on how the Fed runs, right? They just want to give the people what they want. So they'll often have someone write an article on the Wall Street Journal opinion about, hey, should we be cutting rates? Or they'll say something, or they'll say the opposite. They'll just see what type of reaction to get. And so that's the stuff that we're looking at. But again, right now, you're spot on with how you open this dialogue. It's tariffs, it's Fed funds, it's inflation. It's Army getting a little too frothy in valuations. We talked before about Buffett's getting cash build up is the rumor, right? So that's always a negative indicator. But again, it's still too early to say because Buffett may be building up cash, but he hasn't talked much about it, right? So he tends to be a pretty good indicator if he himself thinks his style is getting too frothy and he just wants to pull back. That could be the case, but as far as we know, he hasn't talked about that. So yeah, I mean, there's a Wall Street Journal, all the headlines. I'd just say try to understand your own biases. If you tend to get the same news source over and over again from the same channel or the same paper, try to go look at the other side, see what they're talking about. You may not agree with it, but it's good just to hear what the other side or what another devil's advocate is talking about. And for us, again, maybe it's a contrarian indicator in itself. You just don't hear a lot of people nervous about a recession this year. You don't hear a lot of nervousness about a default contagion, right? So really what keeps us up at night at Thornburg is if the bond market gets really bad and all of a sudden the sovereign debt that's massive, that they have trouble issuing that, you really want to watch that as closely as anything. And the good news is, as much as there's a lot of debt sloshing about, no one's talking about bad debt or default wave or liquidity problem, or God forbid, they're not talking about systemic risks that would lead to a banking collapse. Such was the case in 07, 08, where I think empirically we're not there. It takes a lot more time for that type of human nature and froth to build up in the banking cycle.
Great. Maybe we talk a little bit more about Buffett's cash. It's a topic I always find really fascinating, and we did have right when you said it, we had a question come in on Buffett's cash. So
Okay.
it's great timing, but uh, I always think about it a little bit like a portfolio in the sense that Buffett still owns companies, he still owns stocks, right? So none of us are completely divesting. It's just a company that's built up additional cash, right? So they've sold out
Right.
of positions, but have built up additional cash and remain as investors. But I also think of it as that, Warren Buffett and Berkshire in particular, they buy, you know, they buy companies differently than you and I buy companies, right?
Right.
We buy stock and we're investors and we're looking for market movement, but Warren Buffett is buying kind of companies that have I don't know how active they are as an investor, but I think of it a little bit differently. Are you seeing kind of the same thing? Is that Buffett's buying companies that he thinks they can add some type of value to or influence, and
Yeah.
I mean, and we're not doing the same thing as investors.
Yeah, I mean, again, it's hard. You got to respect what his whole style is about, and to his credit, he doesn't pull his punches. Has not changed any major aspect of his philosophy. Right? He's kind of the Ben Graham value investor style. Like, is it something that I would buy yourself? Some trust yourself. If it is, and tend to have a very long term view of it, and just makes it what's the real worth? What is that company really producing? And then, oh, by the way, that's really test the free cash flows, the balance sheets, the debt, all those, the check the box, which is kind of legendary. Most average investors now follow his style, which is a great style. It's a great for people that are just learning about investing. It's a great style to mimic. But that said, I mean, that what's probably law. Warren Buffett has not participated in the AI rally the last 2.5 years, right? So, and he probably has to. Again, I haven't heard a lot of his comments related to it, but he has to respect that there's a major tech arms race that's early days going on. He may, like myself, be curious, and there's going to be some horrific losers in that race at some point, but it's still early days and it's still early tech, and you still don't really know the full benefit and monetization of the technology. So meanwhile, you're just in it, but the spending is there, and you really see that that's going to help a lot of companies in the short run, and it's helped the economy in the short run. All those are factored in, right? So, but I'd say, again, I would probably turn more to my colleague, Brian McMahon, who runs, co-founder of our firm, who kind of runs the Income Builder. He has a similar mindset. I'd say in talking with him, he's not worried about his really good, the power of dividends, right? His quality, and this is on a global lens. These are international stocks in some cases. He's not worried about these companies having a payout ratio. They're still going to pay dividends, maybe even pay higher. They have great balance sheets, very low leverage, very, really good cash flows. All those things are factored in. And, he'll say, okay, maybe his portfolio is not priced in for a hard recession. But if I get back to my earlier comments, if what you see is what you get, and rates pause and the other economies are kind of floundering, but they're maybe going to be somewhat more, less geopolitical risk, and better outcomes and better animal spirits in the U.S. This is good for all sectors. And I think there's still a lot of cash on the sidelines left over from when rates went higher 2 years ago, that I think a lot of that will, if rates do come down more in the U.S., it's going to find a home where they think better relative value is. And I think value stocks have been somewhat neglected over growth in the U.S. I mentioned international stocks have been completely shunned, perhaps unfairly. So you'll see those cash find a better home in places that offer better relative value. That's kind of the natural order of investing. But yeah, watch Buffett. I think you got to respect, but it's not the end all be all. He is one of many signs that you perhaps want to monitor if you're going to make some tactical changes in your portfolio. But I'd say this story came out, and to my knowledge, Buffett has not really said a lot. It just reported that they're noticing a cash buildup. But if you go look at history, he tends to be pretty good at predicting when to go to cash, when to go to high beta, and but it makes sense that he would be somewhat more cautious on cash because valuations are obviously fuller today than at any point in the last 20 years.
Great. And so if we're looking at measures, I have a question that comes in asking about a measure of volatility. And when we look at volatility, how much are we watching just the daily volatility that's occurring in the measure, or are we really trying to focus on the factors that are creating the volatility, right? Like, can we use volatility on its own? Should we be watching that closely, or is it something, hey, what are the factors that are leading to this volatility?
Yeah, no, that's a great point. You do have to put the factors in context. I think it's fair to put a lot of different. So now you can put a volatility factor, and it's not just the VIX or standard deviation in an investment. It's like, you can do probability. You can do gambling probability now. A lot of people they're judging the volatility based on prediction model gambling. So now gambling is so prevalent, you can basically have prediction models based on money spent. It was big in the election cycle between Trump and Kamala. That was a big cycle, right? And arguably it was a better predictor than some of the pollsters on the outcome of the election, right? So there's a lot more time spent on that. So that's built into your question about volatility, right? So, but I would say the longer that you spend time at the higher, historic values, the more susceptible you are to short-term volatility. So I would put it, and you can be subject in certain sectors to manipulation, right? There's some stories maybe that some of our adversaries are spending time, manipulating the CBOE and some other spots, right? So that, and God forbid we talk about crypto or others, right? There's a lot of areas that just are not as well traded that can get very high volatility, even intraday. As long as you know what you're looking at or investing at, understand that. But traditional measures of volatility, I would say that we tend to look at is if you see a spike in the VIX, if you see a bit better bid ask between bond trading or more volatility in U.S. Treasury yields, we have to issue a lot more Treasury debt than ever. So if you see a lot more yields because of auctions, you can't get this, not enough buyers, so they have to move rates higher. If you see volatility there, that's a signal that maybe you're going to see more volatility throughout all capital markets. So that's stuff our desk spends a lot of time on. I'm sure our competitors do the same. But to take it with a grain of salt, because it can be manipulated by, drops news stories or some unfounded rumors. You tend to smooth it out and create a moving average. But yeah, I would just report. I mean, the VIX has been pretty well behaved throughout all this news cycle. Bid ask has been strong. Issuance continues by major debtors. So all that stuff, if you're looking for kind of the nightmare scenario, is not played out in any sense in the last 4 months, 6 months, and it looks to be fairly robust despite all these news stories we talked about before on tariffs. I don't know if that's what your client was asking me about, but it's a good way. Don't just like the Buffett. Don't try to look at just one factor. Try to mitigate that factor. If you're looking at volatility, look at other sources besides the VIX as a good indicator of volatility. And again, ironically, I'd say based on a massive news cycle, I think the VIX and other volatility has been amazingly well behaved.
So if we're talking about the news cycle, a question came in here. Obviously there's kind of our two big names in the news cycle, and I mean one being the president, which we shouldn't be surprised about, but also Elon Musk in the news cycle. And just curious, there's a feeling like there's kind of a concentration of power between Trump and Musk in Washington right now. Is that creating, additional risks in the market as we see it currently? I mean, obviously we don't know where anything moves into the future, but right now, is there anything that you see, that additional instability or stability that comes from that? Is there some additional risk we're going to see just from this kind of what feels like a concentration in power?
Yeah, I mean, without a doubt, the biggest risk is uncertainty, right? It's even if perhaps you agree with the policy, which some people clearly do. So, I mean, in general, businesses like lower taxes, more productive workers, elimination of so-called, more efficient government. But it's a question. Go back to the original thought the opposition party has. Is this a constitutional? Is this too much power? And are they neglecting the proper channels to execute the power, right? So, and then this will be tested pretty heavily in the courts. You're going to open up just a whole bevy of new lawsuits already starting. But again, it's kind of going back to the Trump and the tariff debate. It's kind of the art of the deal, which I think Elon Musk is starting to learn. And again, Elon Musk is just such a brain that just kind of sees things either black and white, either it's productive or it's not. And you got to remember, you're dealing with livelihoods here, so it's a real tough subject in that sense. But I think the good news is early on, this is getting a lot of bipartisan support from polls. There was so much extra spending because of COVID, and to a level of 3 or 4 trillion extra dollars that really wasn't even spent or misspent or unemployment benefits. That should be an easy layup bipartisan issue to kind of go through line by line and find inefficiencies. And I think the more they expose that, the less fear you have about concentrated power amongst Elon and Trump. But I mean, this is the way U.S. politics works. To the victor goes the spoils. The race was won. Biden won the prior administration and got to do some things his way. And I just keep reminding people, if you're very passionate about politics, it's understandable. I don't want to disrupt it. There's a lot of really profound social and cultural changes going on. But as an investor, the economy, the U.S. economy in particular, is so massive and so complex that I'd say if your biggest fears, if you're not a pro-Trump or pro-Elon person, there's this economy can still do quite well despite whatever dysfunction you think is happening in Washington, right? So hold your hat on that. And I think in general, if you can get some efficiency gains, better. Again, what businesses want and what investors want is just kind of better certainty. We don't want to have things keep changing every year or so in a radical fashion. If somehow we get out of this, better trade deals, less geopolitical risk, better regulation, and more efficiency of dollars spent, the net effect of that, it will be a better investing backdrop. But I mean, but without a doubt, there's more to come, and it's a question of how much they want to pull beyond the 100 days, right? If they get some success and then they all of a sudden tackle areas that are perhaps more conflicted or more confrontational. I think watch the defense spending, for example. That's everyone should be for less spending or savings on something, but then you realize how many districts are affected by the cut in spending, how many jobs are affected, both in Democrat and I'd be very surprised if a massive amount of cuts happen in defense because it's so entrenched in the U.S. economy politically. But they're going to try, and that's a very unpopular policy, for example, for dyed-in-the-wool Republicans, and that's going to be interesting to see how that plays out. So that, I mean, but they're not sparing their punches, right? This is exactly what they said in the campaign trail. They're rolling it out the first 100 days. Some people are really caught up on it politically, but I'd say look at the markets. The markets and other opposition leaders, they're largely taking it in stride, and they're trying their best to have a fair debate in open channels and then through legal channels. So it may seem abrasive, and it's certainly an ugly messaging, but so far it seems to be constitutional and legal.
Great. And so we're almost at time here, but another question came in asking about the run up in gold, right? And so are we seeing this run up in gold? Is this a function of a dollar strengthening, or is it basically a flight to safety where people are using it as a place to say, hey, now I need to be safer and allocate to gold? Is there anything in particular?
All of the above, right?
All of it. Yeah.
And again, just for the record, I've been a chronic, if whatever I'm saying on gold by my historic standards, you want to probably take the opposite side, because I've never been. So as a bond manager, when I first started, gold was a very big barometer of how to invest. It was a classic inflation hedge, a good way to predict inflation was going to run high or low. It's no longer been that. It hasn't been that for a while. Very speculative. I think some of the additional love for gold this last run is because you're seeing crypto at all time, blockchain in particular, or Bitcoin is at all-time highs. And there's a sense there's going to be a lot of deregulation there from this administration. There's probably some truth to that. So, and then you also have the Fed pausing. So there's a sense that, all right, the Fed must be nervous about inflation coming higher. So the kind of that 1-2 punch about it, it's another way to add on to your current crypto holdings. Good diversifier, tends to be a good hedge traditionally to inflation if you think inflation is going to run higher, or at least not collapse. And it just hasn't had the same run up as Bitcoin, I think, is how I view it. But it is so hard. I mean, it's a super cyclical sector. For those of you that kind of invest in it, to understand the risk there. Talk about volatility, right? It's in some days you can get 2, 3, 5% intra-hour volatility in gold or Bitcoin or that. So just understand the risks if you go down that path. But traditionally, if you look longer term, gold is a great diversifier, lowly correlated asset, hard asset. Some people actually have gold bullion in their own safe. So, but yeah, as far as Thornburg having, it's just so hard to make an investment plan. We'd much rather get in the way we run things, our arms around the investments and have speculation and volatility and kind of whimsical news stories affect your asset classes. Again, I'm not being dismissive of the question or the investment.
No,
It's just something that certainly we're not heavily involved with at Thornburg, but we watch it. But it's not the same barometer it was 30 years ago as far as an inflation hedge. And back to our earlier comments, I do think in general rates have peaked in the U.S. and are coming down elsewhere. And I think the economy is slowing globally. And normally that's not the time to go huge overweight to gold when that happens.
great. So as we wrap up time here, always maybe just a quick answer on all these things happening in the market, all these news headlines. What has Ben excited about as an investor?
Yeah, I mean, I guess I'm most excited. I mean, I don't want to sound corny. I'm just most excited about this country and how resilient. I mean, it's just amazing how there's so many dysfunctional things that are happening. As you said, your news sources are filled with negative stories. We just went through a pandemic. We've got major wars issues, major humanitarian. I mean, it just all the while we just keep getting very productive people to be attracted to this country. And I know AI is getting all the love and innovation. That in itself is a major story. But I'd say even it's an amazing time to be alive as an investor in the sense that you can't deny look back 5 years from now and you'll see terrific changes and improvements, I think, in people's lives, in companies and how they're run. I think that all these lessons that we've learned the last 20 years, hard lessons in some cases, with the banking crisis and the collapse and foreign wars, and if you somehow get a little bit of a pause and it's going to be austerity. There's going to be definitely changing sands and winners and losers. That's always the case. But the net result is this is a really good time to be alive as an investor and be productive and stay productive as a long-term investor. I think just to be excited about the opportunity set and the innovation that's coming down the pipeline. I won't talk product today. We certainly have a lot of great product that we manage, but I would hope a lot of my colleagues or competitors are saying the same thing, that you kind of tear away the kind of visceral, cultural that's hit each other politically, which is still the case, sadly, and take it away. It's actually a really good, productive economy, and it's a great time to be alive as an investor.
Well, that's really great. Well, thank you again for your time. Just to everyone who joined us today, if we didn't get to your questions or if you have additional questions, our team is happy to answer them. I know Ben and the team over at Thornburg would be happy to answer any additional questions that come through. But again, Ben, thank you for your time. We appreciate you. We appreciate the help from Thornburg, and we'll talk to everyone soon. Thanks again.
Great. Thanks, Kyle. Appreciate it.